Imagine this. You're standing on the threshold of a dream. Years of saving, dozens of sleepless nights, stacks of documents. And then, there they are, the keys. A symbol of security. Your fortress. But 6 months later, that fortress begins to feel like a prison. Those same keys lie on the table next to an official letter from the bank, and you realize, one wrong move, one missed payment, and the dream will vanish. This is the classic arrival fallacy, the false belief that achieving a goal will bring lasting happiness. You thought you'd reached your final destination, but in reality, it was just the beginning of an anxious marathon. This brings us to an uncomfortable question banks don't want you to ask. If one missed payment can cost you your home, was it ever truly yours to begin with? Or did you simply sign the world's most expensive lease agreement where the rent is disguised as a mortgage payment and you've put your financial future on the line for the next 30 years as collateral? In the next 15 minutes, we're going to hack the system. I'll show you the math that proves you're paying for 3 homes to live in one. We'll dissect the legal loophole in your contract that makes the bank the true owner. And most importantly, we'll uncover why the word mortgage comes from an old French term that literally meant death pledge. It was the financial equivalent of a feudal oath, a vow that remained in effect until the debtor's death, or the full repayment of the debt. Let's start right now. The word mortgage originated from Old French. Mort means death, and gage means pledge or oath. Literally, it's a death pledge, a vow that dies either when the debt is paid or when the borrower loses the property. The system warned you from the very beginning. You just didn't know how to listen. Interestingly, there was an opposing term, vif gage, or live pledge, where the income from the mortgage property went towards repaying the debt. However, the modern system chose the death model, where your income is irrelevant, only the payment itself matters. Let's translate this death pledge model into numbers. Suppose your home costs $10 million. With a standard 30-year rate, by the end of the term, you will have paid the bank approximately $26 million. You bought one home for yourself and another 1.5 for the bank. The bank takes no risks. It creates money out of thin air, lends it to you, and earns a triple profit, secured by your future. The advertised price of the home is just the tip of the iceberg. The true cost is hidden underwater, a gigantic mass of interest that you'll carry for decades. You're not buying a home, you're buying debt. The house is merely a bonus you might receive at the very end. Here's the cruelest part of this mechanism. For the first 10 to 15 years, 70 to 80% of your monthly payment consists of pure bank interest. You work yourself to exhaustion just to pay the bank for the right to keep paying them. The principal of your debt, the actual cost of the home, barely decreases. It's like pushing a massive boulder uphill. For the first 10 years you exert titanic effort, but the boulder barely budges. All your energy goes into overcoming the friction of interest. Only when you're utterly exhausted and the bank has already reaped the lion's share of its profit does the boulder finally begin to yield. Don't just take my word for it. Open any mortgage calculator right now. Enter your loan amount, term, and interest rate. Now, find the total payments field. That figure represents the true cost of your illusion. Your brain, like mine, isn't intuitively wired to grasp compound interest over the long term. This is what Nobel laureate Daniel Kahneman would call a failure of System 1, our fast, instinctive thinking. When you see that final number, you're forced to engage your System 2, your analytical mind. And this awakening from a 30-year financial coma can be painful. You're told, you're not spending money on rent, you're investing in your equity. Equity, a beautiful word. But your equity is just a number on paper. It's frozen, illiquid money. To access it, you need to sell your home. And when you sell, who gets the money first? That's right, the bank. Your equity is whatever remains after the true owner takes their share. Your home equity is like casino chips. They look like money, and you feel rich holding them. But to turn them into real cash, you have to leave the game. That is, sell the house and cash them in at the cashier. And the casino owner, the bank, always takes their cut first, leaving you with scraps, if anything at all. But even if you're willing to accept this ruthless math, there's a more serious problem. It's hidden not in the calculator but in the fine print, in the legal wording of your contract. And it proves that the word owner is merely a polite address for a lifelong tenant. This proof is hidden in a single word you almost certainly overlooked in your contract: encumbrance. Your name might be on the deed, but that doesn't make you the owner. It makes you the title holder. You're simply holding the property as collateral for the true owner, the bank. Your encumbered ownership is like being a computer user, not its administrator. You can change the wallpaper, install programs, and work on it every day. But the bank has root access, the system administrator's privileges. If you break the rules, they can lock your account and change the password at any time. Imagine you're living not in a modern city, but in Renaissance Florence, and your patron is the Medici Bank. They allow you to live in a luxurious palazzo, host receptions, and call yourself its owner, but everyone in the city knows who the true master of that palace is. Your name on the door is just a temporary courtesy. You're not a lord, but a lifelong caretaker of a castle with very strict rules. Now, let's look at this from the bank's perspective. For them, your home isn't your dream. It's an asset in their financial portfolio, a line in a spreadsheet with a specific risk level. As soon as you miss a payment, the risk level increases, and the system automatically initiates a problematic asset liquidation protocol. Nothing personal, it's just business. Furthermore, in large banks, the decision about you is likely not made by a person. It's made by an algorithmic risk assessment model. To this system, you're not a person with a family and plans, but a data set with a calculated probability of default. When that probability exceeds a threshold, the protocol is triggered automatically. But the bank keeps you in check not just through the principal debt and the threat of eviction. There's an entire ecosystem of mandatory payments that you don't make directly to the bank, but which make your cage even tighter and more expensive. These are the golden handcuffs of home ownership. First, mandatory insurance. You think you're insuring your home against fire. In reality, you're insuring the bank's asset against risks. Read the policy carefully. The first and primary beneficiary is the bank. If your fortress burns to the ground, the insurance company won't pay you so you can start over. They'll pay the bank to cover the remainder of your debt. You'll be out on the street, but debt-free. This isn't protection for you. It's a guarantee of investment return for them, which you pay for. Second, property taxes. You pay these directly to the government, but this obligation is firmly embedded in your contract with the bank. If you miss a tax payment, the government gains the right to seize the property. For the bank, this is a direct threat to their collateral. This is why they often insist on an escrow account. This is a special account where you monthly deposit a portion of your taxes and insurance along with your mortgage payment. The bank then pays these bills on your behalf. They don't even trust you to manage these expenses. They create a financial gateway through which they control everything concerning their asset. Third, endless maintenance. A leaky roof, old pipes, a crack in the wall. These aren't just your household inconveniences. They represent a depreciation of the collateral. Your contract likely contains a clause obligating you to maintain the property in proper condition. You are legally bound to spend your money and time ensuring the bank's asset doesn't lose value. Every penny invested in repairs is your free labor to capitalize someone else's property. This entire system, insurance, taxes, repairs, isn't an investment in your future. It's operational overhead. You are an asset manager who pays for the right to manage. Imagine you lease a factory for 30 years. Under the contract, you're obligated to insure the equipment, pay property taxes, and conduct full modernizations at your own expense. Meanwhile, all manufactured products go to the factory owner. Your home is precisely such a factory. It produces only one product: profit for the bank. This is a financial mechanism perfected to its core. It completely shifts 100% of the risk and 100% of the expenses from the actual owner to the temporary user. The bank owns the home but bears none of the costs for its upkeep. It doesn't pay its taxes. It doesn't fix its plumbing. It doesn't insure it at its own expense. You do all of this. You are the ideal manager of someone else's property, generously paying for this dubious privilege. And this manager's privilege has its rigid, invisible boundaries. Try to sell your home. You'll immediately discover it's not a simple sales transaction. It's an operation to repay debt to the primary creditor. All funds first pass through the bank's hands. It takes its share down to the last penny, and only then remits any remainder to you, if there is one. You can't just take the money from the buyer. You don't even have the right to touch it until the true owner has received their due. This is akin to a company liquidation. The bank is the secured creditor. You are merely a shareholder. When assets are sold, creditors always get paid first. Shareholders receive the remnants. This principle of the bank's absolute priority is written into every line of your contract. At the moment of selling the home, you see the entire hierarchy of power in its pristine form. And in this hierarchy, you are on the very bottom rung. You are last in line to receive money from the sale of an asset that you maintained, repaired, and paid for over 30 years. But the most ingenious aspect of this system is its psychological core. It exploits your biological need for shelter. It takes the ancient instinct of my cave, my fortress, and monetizes it. A deed with your name on it isn't a legal document of ownership. It's an emotional contract that compels you to protect the bank's asset as if it were your own child. You'll work 2 jobs, deny yourself everything, sacrifice your health, all to avoid losing something that was never truly yours to begin with. You are not an owner. You are a custodian, an emotionally invested, financially responsible guardian of a bank's asset. The entire system is built on a misrepresentation of concepts, where the legal right of use is disguised as the sacred right of ownership. The bank isn't selling you square footage. It's selling you the idea of a home. And these are 2 entirely different products, with vastly different price tags. And this product, the idea of a home, is sold using a specialized vocabulary. For you, they have the word nest. For themselves, they use the word asset. For you, family hearth. For themselves, secured debt obligation. This dual language isn't accidental. It's the foundation of their marketing strategy. Its purpose is to create an emotional connection with what, according to documents, is merely a financial instrument. Your mortgage broker isn't your friend. They are a salesperson working on commission from the bank. Their job isn't to find you your dream home, but to sell you the largest debt you can possibly service. Every additional million in your loan is their bonus. They are the friendly interface of a ruthless system, trained to speak the language of your hopes to sell you a product described in the language of their profit. But the real trick happens after you sign. You think your contract will sit in the safe of a local bank branch. It won't. A process called securitization occurs. This word sounds complex, but its essence is simple and brutal. Your mortgage, your personal story, is chopped up, mixed with thousands of other similar stories, and pressed into a single financial brick. It's called a mortgage-backed security. This brick, in which your home is just 1 grain of sand, is sold on the global market. It's bought by pension funds, insurance companies, and anonymous investors from the other side of the planet. They've never seen your home. They don't know your name. To them, you're just a line in a yield report. They didn't buy your dream. They bought the right to receive your monthly payments. What does this mean for you? It means the bank you go to make payments at is likely just a service company, a facade, an operator that collects money and forwards it to the true, invisible owners of your debt. When you encounter problems, you won't be speaking to the person who made the decision. You'll be talking to a call center employee working from a script approved by a faceless investment committee in New York or London. This system is ingenious in its impersonality. It severs any human connection between lender and borrower. Your debt no longer belongs to the bank around the corner. It's dispersed among hundreds of anonymous owners. You no longer owe John Smith. You owe the global financial system. And the system has neither empathy nor flexibility. It only has protocols and yield targets. You thought you were entering a long-term relationship with a specific bank. In reality, you simply sold your financial future on an open auction. You became raw material, a product that was packaged, branded, and sold to the highest bidder. Your home is merely the collateral for this global transaction. So, what do you do with this information? Here's a 4-step protocol to reclaim control. Essentially, it's your personal forensic audit, a financial and legal examination of your own servitude. Professionals conduct these to find vulnerabilities in companies. You'll do this to find cracks in the walls of your financial prison and plan your escape. First, perform an autopsy. Open a mortgage calculator and look again at the total amount of payments. Grasp that figure. Don't look away. Second, find your contract. Locate the words pledge and encumbrance within it. Read those clauses aloud and understand who the real owner is. Third, build an escape route. Create a plan for early repayment. Even 10% extra on your monthly payment can save you years of servitude and hundreds of thousands of dollars. And fourth, change your mindset. You are not an owner. You are an investor buying a share in an asset from the primary owner, the bank. After everything you've heard, I want you to answer one question. What is a mortgage to you now? Is it a well-designed tool for achieving a dream that needs to be used correctly, or is it an inherently disadvantageous trap from which you need to escape as quickly as possible? Write just one word in the comments: tool or trap. Let's see which perspective is more prevalent. This choice is your personal red or blue pill. Tool is the blue pill. You accept the system's rules and try to play it as effectively as possible. Trap is the red pill. You see the matrix of debt and seek a way to exit it. There's no right answer, but your choice will define your financial philosophy for years to come.